Hello, Accounting Superstars. Welcome to the Accounting Superstar channel. Glad you're back. Today we are studying leases. I'm Professor Don Bush. I've been teaching accounting for about 30 years, been a CPA for that long, and I've got a lot of great ways to explain accounting. So let's get started. The example for today is identical to the last example. In example 1, we studied financing leases from the lessee's point of view, but with an unguaranteed residual value. In this lesson, we're leaving the numbers the same, or at least the data, the information the same, but we are changing this lease to where it has a guaranteed residual value, and you'll be surprised that one little difference is going to change pretty much all the numbers, and it will change your journal entries just a little bit. So that's why I've been telling you guys over and over again that these guaranteed residual values or unguaranteed residual values, you got to watch those. They make a big difference. So let's get started. So the first step here is understanding the facts. And as you know, if you've been watching these videos, I like to lay out what's going on. So if you're working on a leasing problem in your textbook for homework, write down what the facts are. Just list them out, because that way they'll come to the forefront of your mind. You'll be aware of them. And also another thing too is I hope you're doing this all on Excel. Excel's fantastic. And what you can do is you can type in your numbers that you'll need. And this way you don't have to type them again. All you got to do is copy and paste or use them in formulas, and you're good to go. Less chance of mistakes. So let's get started. 1.1, when we get to construction, is leasing an electric generator from Power to the People. Lease agreement begins January 1st, 2001. Generator is not of a specialized nature. Again, what's a specialized nature? This is not a special generator. It was not built specifically for when we get to construction. It's just a generator. Lease is non-cancelable. When we get to a construction or Power to the People can't cancel the lease. It's going to go for the lease term here of 3 years. Generator fair value at beginning of lease, $3,000, same as the last example. Generator economic life, 4 years. So when we get to a construction, it is going to lease this generator for 3 out of the 4 years of economic life. So 1.8, estimated salvage value at the end of the lease, guaranteed. I've got that in bright red letters. At the end of 3 years, $500. So at the end of the lease, that generator had better be worth $500, or when we get to it, construction's got to make up for it by paying cash. So 1.9, no lease renewal options. When we get to construction, we'll not own the generator. Number 1.10, the incremental borrowing rate, collateralized loan for when we get to is 5%, same as last example. 1.11, lease payments are made annually at the beginning, January 1st, 2001, beginning of each year, not at the end, but at the beginning. 1.12, when we get to depreciates the equipment on a straight line basis. And 1.13, when we get to it, pays executory costs, for instance, maintenance. What are some other executory costs? Do you remember? How about taxes or insurance? We've got maintenance here. The amount is $100. So when we get to construction, is adding on another $100 to their lease payment to pay for maintenance. Apparently, Power to the People wants to handle the maintenance and make sure that generator stays in good condition. So going down to the payments, here we go. Now this first part is the same regardless if it's guaranteed or unguaranteed. Doesn't matter at this point. Find the present value, the residual value, $500. The interest rate, 5%, and folks, that comes from the information up above. The lease term is 3 years. So let's find the present value. So once again, we go up here to formulas. We go to financial. We come down here to NPV, net present value. And we put in the values, and this is going to be a lump sum, present value of a lump sum over 3 years. So the rate, all we have to do, if you've got it typed out here, all you got to do is 5%, just click on it. Now, since this is the present value of a lump sum in 3 years, value 1 is going to be 0. Value 2 is going to be 0, but value 3 is going to be that $500 residual value. And all you have to do at this point is press OK, and you got the answer, but I already have the answer, so I'm going to cancel out. Otherwise, it'll kind of mess things up. So 2.2, the amount to be recovered through lease payments. So the fair value of the lease generator, $3,000, less the present value of the residual value. And we got that $431.92 from right up above a moment ago. The amount to be recovered through the lease payments, $2568.08. That's exactly the same thing as in the example number 1. So far things are the same. Determine the amount of annual payment. Here we go. Amount to be recovered through the lease payments, $2,568.08. Got that from right up above. Interest rate, 5%. Number of annual payments at the beginning of each year. So what would be the annual payment be? How do we figure out this $898.12? Well, we're going to use Excel again. Excel is a wonderful tool. All we do is go up to Financial, come down to, let's see here, Payment, PMT. There we are, PMT. And you type in the rate, 5%, or you can just click on it if you got it typed out like I do. The number of payments is going to be 3. The present value, $2568.08. And the type, it's really important for the type that you type in the number 1. Why are we typing in the number 1? Well, because the payments are due at the beginning of the year. When you type in the number 1, that tells Excel the payments are at the beginning of the year. If you leave it blank, that tells Excel the payments are at the end of the year. So if I hit OK, I'll get the answer, but I already have the answer, so I'm going to click cancel. And there we go. So the answer is $898.12. So in other words, 3 payments at the beginning of each year at 5% is going to equal $2568.08. So they're both equivalent in present value types of terms. So add executory costs paid by when we get to it, $100. Total annual lease payment, you take the $898.12 plus the $100 and you get $998.12. There you go. Now here's where things get a little different, folks. Right here, the present value of the minimum lease payments. And so we're here, step number 3, amount to be capitalized by the lessee. Here's where we get different, and there are 4 different minimum lease payments. There they are. And so we got to determine what they are. Minimum lease payments include the following. Number 1, rental payments. So I just wrote down $898.12. Where did I get that number from? It comes from right there. $898.12. Do not include the executory costs. Bargain purchase option. There's no bargain purchase option. When we get to construction, we'll not be able to buy that generator at a vastly reduced price. Number 3, guaranteed residual value. Well, that is $500, and it's guaranteed. We exclude unguaranteed, but we include guaranteed. So we're putting down $500. Penalty for failure to renew lease. Nothing there because we're not renewing the lease. The lease will not be renewed. So now I put these numbers up here to kind of almost like placeholders, just so I get the idea of what's going on. But what we really need is the present value of those numbers. So the present value of 3 payments at the beginning of the year at $898.12 is equal to, here we go, $2568.08, $2568.08, and that's what we really want, the $2568.08. So the present value of lease payments, amount to be recovered through the lease payments, $2568.08, and then the present value of the guaranteed residual value, $431.92. Where'd that come from? Came from right up here. There it is. $431.92. And all we do is bring it down. See, with Excel, you can do that. It is so nice and easy. Here we go. So the total amount to be capitalized by when we get to it is going to be the total of these minimum lease payments. So $2568.08 plus $431.92 equals $3,000. That also happens to be the fair market value at the beginning of the lease. Doesn't have to be, but it is in this case. Step number 4, double check and determine if operating lease or financing lease. So here's our chart, and you can see that I have a couple of yeses right here. Anytime you see a yes, that means it's a financing lease. If these were all no, that would be an operating lease. But let's go through them here. You can see it's going to be a financing lease. I've already got the answer laid out for you, but let's look through it here. So test number 1, the transfer of ownership. Is the generator going to belong to when we get to construction ever? And the answer is no. At the end of the lease, the generator is going to go back to the lessor, power to the people. Test number 2, bargain purchase option at the end of the lease, and the answer is no. When we get to construction, won't be able to buy that generator at a vastly reduced price, like say for $1. Test number 3, the lease period is 75% of the economic life. Now the lease is going to go for 3 years, and the economic life is 4 years. So 3 divided by 4 is 75%. So yes, it meets that test. Is the lease period 75% of the economic life? And it is. So that test right there says that when we get to a construction is really buying this asset. It says it's a lease. The contract says it's a lease. But when we get to a construction is buying this asset. And so according to accounting rules, we have to put the asset and the liability on the balance sheet. Test number 4, the present value of the lease payments equals 90% of the fair market value. Well, the present value of the minimum lease payments is $3,000. We did figure that out, folks, right here. This very important step here, step number 3. We found out right here the total amount to be capitalized by when we get to a construction, $3,000. Right there, that's where it comes from. Fair market value, $3,000. So if you take 3,000 divided by 3,000, you get 100%. And so yes, that's equal to or greater than 90% of the fair market value. So we did meet this test. Last test here. We really don't have to do the last test because we already know it's a financing lease. All you have to do is meet one of the criteria, and it's a financing lease. But let's do it anyways because just so we can learn what these tests are about. So test number 5, specialized use. Is this generator built specifically for when we get to a construction and nobody else in the world could ever use it for anything else? The answer is no, it was not built specially. It's just a generator. You could probably get one at Home Depot or Lowe's and you'd be good to go. So it's a financing lease. Now the amortization table is going to be a little bit different too. So here we go. So what I've got here on the first line here, I've got the date 1-1-2001. This is the date that the lease is signed, at the beginning of the lease. And the carrying value of the lease liability is $3,000. That is also the amount of the capitalized asset. So amount to be capitalized by when we get to it, $3,000. So that's where that number comes from. There we go. Okay, so also on the date of the lease signing, 1-1-2001, when we get to construction's got to make a payment. So they make a payment of $998.12. 100 of it is going to go for that maintenance cost, the executory costs, and the rest, $898.12, is going to go to reduce the liability. So if you just take $3,000 minus $898.12, you get $2101.88. Coming down to the next line, this is the very beginning of year 2. Well, when we get to construction's got to make another payment, $998.12, executory costs $100, but this time we have interest. And how do we figure out the interest? Well, all you do is take 5%, that's the interest rate, times the previous balance, $2101.88. You get $105.09. So to reduce the lease liability, all you do is take $998.12 minus $100 minus $105.09, and you get $793.02. And lastly, the new carrying value of the lease liability is $1308.86. Where'd that come from? $2101.88 minus $793.02, and there you go. Well, the beginning of the third year is the exact same thing. It's the exact same process. $998.12 is the payment, $100 is the executory cost, $65.44 is the interest, that's 5% times the previous balance, $65.44. Reduce the lease liability. All you do is take the payment, minus out executory and interest, and that's how much you're going to reduce the liability. And you end up with $476.19. How'd you get that? Well, 1308.86 minus 832.67 is 476.19. Now at the very end of the lease, December 31st, 2003, at the very end of the lease, when we get to construction, it has that guaranteed residual value. And so what that means is at the end of the lease, that generator needs to be worth $500 or more. And if it isn't, then when we get to a construction, it's got to make up the difference. So one way or another, when we get to a construction is going to give up something worth $500. So $500 is our guaranteed residual value. There's no more executory costs because the lease is now over. But there is interest because there was a lease liability. Whenever there's a liability, there's interest. So all you do to find this interest is 5% times the previous balance, and you get $23.81, not a lot of interest. And reducing the lease liability, all you do is take 500 minus $23.81, you get $476.19. And so the lease liability is completely satisfied. We're zeroed out. So all you do is take $476.19 minus $476.19, zeroed out. And folks, it's got to equal zero or something very close to zero. You could be a couple pennies off due to rounding, but if you're more than a few dollars, if you're $100 or $500 or $1 million off, you did something wrong. And folks, you cannot go on. You got to fix your amortization table, because if your amortization table is wrong, nothing else will be correct. So going on to the depreciation schedule. Here we go. Made up a little depreciation schedule. And this is slightly different than last time. Not a lot, but a little bit. So the amount to be capitalized, $3,000. You might say, where's that come from? Well, it's right here on our amortization table, and you can find it up above in many places. Less guaranteed residual value, $500, so the amount to be depreciated, $2,500. The lease term is 3 years. The economic life is 4 years, so we're going to take the smaller of the two and depreciate it over that time period. So we're going to use 3. All you have to do is a little division, and you'll get $833.33. That's all there is to it. So here's my little depreciation schedule. $833.33 in the first year, $833.33 in the second year, and then in the third year I've got $833.34, and I did that just so it works out nice and even. Here we are down to the journal entries, and for the journal entries I'm going to split the screen so you can see what is going on here. So it's always good to look at your amortization table. Record the lease, January 1st, 2001, leased equipment and lease liability, and we get $3,000 for those amounts, and it comes from the amount that we are capitalizing. It's on our amortization table, and you can find that number up above in several spots. Record first lease payment, January 1st, 2001. So this is being done on the date the lease is signed. It's the payment up front. So we have lease liability of $898.12. Here we are, $898.12. We're using this first line of information. The maintenance expense, the executory costs are $100. We're paying out cash of $998.12. So all the information you need is right there on your amortization table. So coming down the journal entries, we have a couple of journal entries here at the end of the first year. Well, at the end of the first year, we have interest expense of $105.09 that came from right here. You see, because during the first year, we had a liability of $2101.88, and we were accruing interest at 5%, and it added up to $105.09. So we have interest expense, interest payable, $105.09, and that payable will be due on the very next day, January 1st, 2002. Depreciation expense is $833.33, and we get that off of our handy little depreciation schedule. Look at that, it's all spelled out there for us. So That's all there is to that depreciation. Well, we've got the first year all done. So coming down to the second year. So lease liability, $793.02, where'd that come from? Right here. We're going to focus on this line right here, the second year. Maintenance expense, $100. Interest payable, $105.09. We got it right from there. Cash, the amount of cash being paid out is $998.12. There we are. Now we have a couple entries at the end of 2002. Interest expense. Well, interest expense of $65.44. There we go. And interest payable $65.44, because this interest of $65.44 is going to be paid the very next day. Depreciation expense and accumulated depreciation, same as before, $833.33, and there we go. So we're down to the last year. And folks, hang on here to this last year, because the very last entry is going to be a little tricky, not too much, but hang on here. So lease liability, $832.67. We get it right from there, $832.67. Maintenance expense, $100. Interest payable, $65.44. We're paying off that interest, and the amount of cash being paid out is $998.12. And here are the two journal entries here at the end of December 31st, 2003. So we have interest expense of $23.81. There you are, $23.81. Interest payable, $23.81. And we have our same old depreciation. It is a penny different, just to make things work out nicely. But here's the journal entry that we want to watch here. We want to look at this closely. And what is happening here on December 31st, 2003, when we get to construction, is giving back that generator. So here's how the journal entry works. Goes like this. So interest payable, $23.81. There we are. We recorded it there on our amortization table, and we have it right up here. Interest payable, $23.81. Lease liability is being reduced by $476.19. There it is, $476.19. That brings the lease liability down to zero. And what we're doing in the last two entries here essentially is we're emptying out the accumulated depreciation. We're closing it out. Accumulated depreciation is being debited for $2,500, because if you add up the accumulated depreciation up to this point, it equals $2,500, so it's being cleaned out, closed out. Leased equipment is also being closed out. By crediting it for $3,000, we're closing that account out. If you recall, on the very first entry, we debited it for $3,000. There we go. There was our very first entry, leased equipment, $3,000 debit. And in the very last entry, we're closing it out, because we're giving that generator back to the lessor. There we go. So all things are finished now. So folks, I hope you understand how this guaranteed residual value works. So when you're working these problems out in your textbook and your homework, keep good track of it. And also, if you go through this step-by-step process, you won't miss anything with leases. So I hope this video was helpful for you guys. And if it was, hit that like button and hit the subscribe button, and that way I'll know to make more of these videos for you. I'll see you later, and over and out.